What is up, everybody? Today we are reviewing Tencent Holdings, the Chinese company probably best known for its super app WeChat. Before we dive into the most recent investor presentation, I do want to point out that this stock idea came from a viewer just like you. So if you have any stocks that you would like to see reviewed, please leave a comment below the video and I would be happy to analyze a stock of your choice. Thanks so much and let's get into it. All right, so to best understand Tencent, we need to first understand all of the different revenue sources this company has. And believe me, there is a lot. As I said, the company is probably most well known for its super app WeChat, which is the main social media and messaging network in China, and it has currently 1.3 billion monthly active users. As a quick note, I do not speak Mandarin, so I will do my best to pronounce these names, but I believe it's pronounced Weixin is a messaging app that is kind of goes along with WeChat, and so that is why you see them together. It's kind of like Facebook and WhatsApp. Tencent also has a mobile payment company that integrates into its WeChat application, and it is currently number one in monthly active users and daily active users in China. Like many other tech companies, Tencent has moved into the cloud business, and they have a number of different products that they offer, and all of these products are quite large and rank really well against their competitors. Tencent also operates the largest mobile browser in China, as well as the second largest mobile security platform. The company also provides tons of digital content, which includes videos, music, and literature, and is the largest company in China that does this. And finally, Tencent also focuses on mobile gaming, and they are number one by users and revenue in China, and number one by revenue in the entire world. So yeah, basically, if you want to think of what Tencent and what WeChat is, it's basically a Facebook combined with a PayPal combined with a Amazon Web Services and Google and Spotify slash like record company slash mobile game designer. I mean, this company does literally everything that has to do with the digital age. It's pretty incredible. Now, a lot of the applications that Tencent has are almost exclusively in the Chinese market. And so considering the large majority of my viewers are from Western countries, I decided it'd be a good idea to at least focus on what we would recognize. And so that really comes down to their mobile gaming unit, and we can see that they have tons of their own IPs. Valorant is probably the most recognizable for me, but they also have Delta Force and HOK World. They also are bringing new IPs to mobile, including Assassin's Creed and Monster Hunter, which I'm sure many people are familiar with. And they are creating their own titles, which we can see here on the right. And if we look at the revenue breakdown by segment, we can see that in general, Tencent has been growing its revenue really nicely since 2020, with just a couple minor hiccups in 2022. The company's largest revenue segment is this FBS at 34%, which is essentially their fintech business, encompassing mobile payments and things like that. Their next biggest revenue segments are their domestic gaming segment at 21% and their social networks at 19%, which again are largely domestic as well. The company's social network revenue has been stable year over year. Their video revenue grew by 2% year over year, and their music subscription revenue increased by over 40% year over year. What's really incredible is that they grew their total subscriptions by 21% over the year, and their average revenue per user grew by 17%. Their domestic gaming revenue grew by 5%, and their international gaming revenue grew by 14% year over year, but only 7% on a constant currency basis, so that 14% is a little bloated just based on Forex fluctuations. And finally, their fintech business grew in the teen percents year over year, and their business services grew by over a double-digit rate, which is really good to see that they are still growing at extreme rates, especially in some of their higher margin services. In Tencent's recent quarterly earnings that were released a couple weeks ago, the company announced third quarter earnings and sales that beat market expectations. They announced adjusted earnings of 64 cents per US share, on revenue of $21.4 billion versus an expectation of 57 cents a share and $21.2 billion in revenue. At the time, this led Tencent stock to jump 5.2%, and the stock has continued to climb since this earnings announcement. So, as always, before we move into the financial numbers, can you please take a moment to like this video and subscribe to my channel? It means a ton to me, and I cannot wait to bring more content to you guys in the future. Thank you so much, and let's get into it. Tencent's revenue has grown exceptionally well, even considering the fall from 2021, and it's growing at just about 16% per year. EBITDA took a little bit more of a hit since 2021, but it is still growing at about 13% per year. And operating earnings continue to expand at almost 19% per year. Tencent's gross margins have stayed very flat over the last 5 years, and that's not super surprising considering the fact that the company is very well established in China, and there's not much major about their business model that has changed in the last 5 years. But 45% all in all is very good. The company's operating margins have taken quite a hit since 2020, and they have started to rebound in the trailing 12 months, but they are still 5% under where they were pre-pandemic. The company has improved its return on assets though, which shows that the company, even though its margins are going down, it is getting more asset light, which is really great to see. Tencent's shares outstanding are basically flat over the last 5 years, so there's really not much to say regarding these. The company's cash and short-term investments have grown exceptionally well, though, over the last 5 years at almost 20% per year. So this company is really loading up on liquidity, and that provides it either a really strong buffer or the opportunity to make some really interesting investments in the future. Long-term debt has also increased, but the company's outstanding debt is less than its cash and short-term investments, so it's not an unmanageable amount by any means. Net interest expenses have fluctuated a lot, but even in the worst case situation in 2021 that we can see, $100 million in interest expenses is nothing for a company the size of Tencent, so they're very healthy in this respect. Free cash flow has also increased really nicely at over 21% per year. And on a per share basis, everything looks essentially the same. Tencent's dividend growth has been really impressive. And what is interesting is that its current dividend yield of 0.7% is 57% undervalued compared to its average yield of 0.44%. So here on this graph, I'm basically charting the weekly dividend yield in black compared to its average dividend yield over the last 5 years in red. So anytime you are over this red line, it means that the stock is trading at a discount to its 5-year dividend yield. For anybody that invests based on dividend yield theory, this would essentially mean that the stock is undervalued. And in Tencent's case, that undervaluement would be about 57%. The company's dividend payout ratio is also very safe, improving from just 8% in 2018 down to 6 2/3% in the trailing 12 months. So Tencent has a ton of room to continue to increase this dividend over time. So now we are looking at a PE chart, and we can see that Tencent's average PE over the last 5 years is 28.38, and it is currently trading at 18.52. This gap between its current PE at 18.52 and its average PE at 28.38 represents an almost 35% discount to the company's average PE. And moving over to the stock chart, we can see that the company currently trades pretty close to what I calculate as its fair value PE at 18.8. And as you probably noticed, that is slightly below the average PE that Tencent has traded at over these last 5 years. Using an 18.8 PE as this company's fair value would give a fair value for Tencent at $42.28 compared to its most recent closing price of $41.62. So essentially what I'm seeing here is that the company is probably just at fair value right now. I do want to point out though that this fair value PE is based on the previous 5 years of growth, and the projected 5 years of growth is only a compound annual growth rate of 2.9. So when I see a growth rate that is below 15%, I like to change the fair value PE to 15. And if we do this, we can see that Tencent is overvalued, at least by my expectations. By the end of 2026, by my projections, the company would be worth about $37 per share. And if we return to 18.8 as the fair value PE, we can see that by the end of 2026, the company would be worth approximately $46 per share. So if this projected compound annual growth of 2.9% per year is true and does in fact end up happening, there's only about 10 to 15% upside from the current stock price today. So to summarize what I like about this company, first and foremost, Tencent is like the everything app of China. I mean, they're in so many different baskets with the different business models that they have that it's really a conglomerate that I don't think can go anywhere. It's the most essential communication and payment and gaming and leisure device in China, and I think that just makes it basically unbreakable. It's its own kind of monopoly. Secondly, the balance sheet is excellent. There's no way around it. I mean, the financial strength of this company is impeccable, and they are seeking to continue expanding at all times. They're moving into new markets. They're expanding their margins. They are doing everything they can to make the company better every single day. They're not just resting on their laurels, and so that's very impressive. Now, what I do not like about investing in Tencent is obviously the fact that it is a Chinese company. I spoke about this at length in my Alibaba video, but for me personally, I think there's just too much risk investing in China due to the outsized control that the Chinese government has over its economy. If I was to invest in a Chinese company, though, I would be worried about the fact that the economy is looking very fragile currently. A lot of this does draw from its real estate sector, and if China is anything like the United States in 2008, the real estate sector could bring down the entire economy. So that would be something to keep an eye out for as well. And the low projected growth is also a worry for me. Tencent is a great company. It's very financially stable, so I'm not worried about it, not being a company. But if you're going to invest in a company at a premium like it's currently trading at, you would hope that it's growing faster than 3% per year. Those are just projections, and Tencent could end up growing much faster than 3% per year, but it is another reason to invest with a little bit of caution at this time, just due to the uncertainty surrounding the company's growth and the Chinese economy in general. So, like I said, I will not personally be investing in Tencent, again, because it is a Chinese company. It is a very strong Chinese company, and if you were going to invest in China, I think Tencent is an excellent company. But please do your research and be aware that you are taking on more risk than if you were investing inside your home country or the United States or wherever else you may choose to invest. So with that, I hope you enjoyed this video. Please take a second to like it and subscribe to my channel. And remember to leave a comment down below telling me what stock you would like to see reviewed next. Thank you so much, guys, and I will see you next time. Bye.